Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for August 24th, 2014. The market is back into bullish normal conditions. On an annual basis, using weekly RSI 14, we're at the high end of neutral with a score of 67 out of 100. On a shorter term basis, using the 10-day NDX, we're in overbought conditions at 92 out of 100. Looking at the market mosaic, price relative to the 200-day moving average has improved to yellow bullish at 6.91%. The slope of the 50 has improved to yellow neutral at 0.27%. ADX has pulled back to a neutral non-trending 22.9, excuse me. The risk index is the 30-period moving average of the VIX divided by the 10-period. A score of 1.0 is the threshold between risk on and risk off. Currently reading at 1.09, or risk on, meaning favorable. It is favorable to own the riskier assets. Take that score of 1.09 and compare it to the last 5,000 trading days and find the standard deviation. That gives us the risk Z, and that reading is currently at 0.97. You can see a 90-day time series of that indicator here. It had gotten as risky as -2 Z-score, and on the uptick, as we alerted, there's a potential for a nice swing trade in XIV, and that was about a 15% move over the course of the last 6 or 7 days in XIV. Blended monthly rebalancing scheduled to occur on or about 1 September. These are the current holdings. And these are the current leaders based on the readings as of Friday for each of these three populations, ETF 13, 22, and 32. And then these are the leading candidates in each of these larger populations as well. In ETF 2, the theoretical exposure of the model is at 80%, and the model portfolio itself will be at 80%. Just a quick look at some of the ETF portfolios here, using that blended monthly rebalancing look. Technology, Latin American emerging markets, only EFA, the global, is on a cash position. In ETF 32, we have a few more on a cash position, basically the commodities in Europe. It is China, Brazil, technology, the BRICS, Latin America, then the S&P technology in S&P 32. In ETF Max, global carbon is of interest, being green and white. We've seen a slowdown in India now, which had been leading the way for about the last 3 months. Biotech is making a move back up, now green and yellow. And biotech and genome, green and yellow. More biotech, green and white. There's a hint there. China is green and white, white. NASDAQ Clean Edge. Pullbacks in India. We'll take a look at that chart and see what that looks like. Inside the S&P 500, Citigroup, U.S. Steel, Family Dollar, Intel, and again you can see the symbols and the sectors which they are found in. Very interested in Family Dollar here, and the green and white. Moving on to the market health check. We have vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal red lines are support levels that have held as support in the past, and which, if price collapses, act as targets on the way down. You can see how in the last 30 days it went from testing all-time highs and collapsed through 3 layers of support, then finally held outside the river for a Z trade pattern. And then on the way back up, they became price targets, and then success back up to the previous swing high with a nice set of bi-directional swing trades here. I want you to notice the size of the daily ranges on the way down, and then the quiet grinding moves on the way back up. On the way down, collapses from strong bullish conditions give you great frog style trades intraday because you have large range days, large signal days. When this finds support and re-enters the river, you get these grinding days. Now we are favored by holding swing trade patterns in bull markets, and that's the basis for using the XIV VXX yin yang pair on the way down for intraday frogs, and then converting some of those to swing trades in XIV on the way up. You can see we were in oversold conditions here for 3 or 4 days, and now we're back into overbought conditions on Williams %R. The jaws of PPO, the percent price oscillator, which does a nice job of finding turning points in swing trends, turned back to the positive here as price was entering the river, which is our normal re-entry point on the long side on pattern 7, with the idea of achieving prices at the far side of the river and hopefully the far side of the floodplain. The river is the dark blue shaded area in the middle. That's the 30-period Bollinger Band ±1. The lighter blue shaded area is the floodplain. That's the 30-period Bollinger Band ±2. You can see the 10-period regression channel formed by the regression line, and then the max excursion during the look-back period, sloping sharply up. You try saying that. And then the 30-period regression channel slightly sloping downward, and you can see here the time series of the slope of that 30-period regression line bottomed out right about here, and now has returned back to the upside, getting ready to go positive when it crosses this dotted line at the 0 line on the left-hand axis. If this were to get as high as 0.4, that would be considered extremely steeply up. It got as high as 0.3 during this nice run-up. And then negative 0.22 is sharply sloping downward. You can see it almost got to that level during this period. And so the rebound, that was more evidence of a rebound from extreme conditions just based on the slope statistic. So that's the market health check. We're right back to all-time highs. And we'll see if this acts as resistance once more. Pullbacks from here, initial target would be the Bollinger Band mean, as you see here. But should this hold, then we would think another move of this magnitude, to around 205 is not out of line. ETF2 regional report. 2 of the 10 indexes are in cash conditions. That gives us a theoretical model exposure of 80-20. It was improvement from 70-30 from last week, so we're back into bull normal. The S&P at 70 is better than the globals on strength, which are at 64, so the U.S. is favored over the globals. Inside the U.S., it's tech at 74, S&P large caps at 70, mid caps at 69, small caps at 66. They're still in the yellow below the database average. 2 strongest sectors, emerging markets and technology. I should actually say Latin America and technology. It's now I just noticed Latin America's moved to the top. And then the 2 weakest, IWM at 66 and EFA at 64. Inside the S&P spiders, it's technology, healthcare, and consumer discretion leading the way. And real weakness right now in the industrials at 67. Market health check, U.S. tech in the green, everything else above average except now a couple of the small caps. That's an improvement in the U.S. posture, which was decidedly worse last week. That nice little bump this past week has helped. Japan and Asia less Japan above average. You can see the leaders in green in the Asian countries. Latin America is back into the green. Emerging markets are above average. Mexico and Brazil doing very well. Everything Europe is below average, and you can see the losers in the red. Treasuries and U.S. real estate above average. Commodities, oil, silver back into the red. Technology is strong as a business sector around the world, so we're looking at the U.S. and the global counterparts. Basically a hat tip to the U.S. across the board. The top 30 ETFs based on the ETF2 framework. You can see weakness now in coming into India. Strength shifting looks like biotech in China. Some residual strength in India remains, but I think some of that's weakening. And now you can see here the green and white stack. Hong Kong, Latin America, the BRICS, Taiwan, junior gold members. Looking at the Dow 30 through the same lens, Intel continues to just dominate, as is Microsoft, Home Depot, and Disney also moving to the top along with United Health. Real weakness in the bottom of the stack here in Pfizer, United Tech, and McDonald's. Weakening in Verizon, which is in the yellow and white. But then white and yellow, we look at J.P. Morgan and Procter & Gamble as being on the way up. So that's, I mean, those are your relative strength winners, and you can reinforce those as long as the U.S. continues to have that dominant position. That's a pretty good stack of 5 right there to look at. Intel, Home Depot, Microsoft, Disney, and United Health. I'm going to shift to the daily report next. Concentrating on pages 2 through 5. No signals in the overreaction or channeling. You can see the volatility that has started to pull back out. We were bull volatile for a while. Now we're back to the 6-month average. That has corresponded with a really nice swing trade in XIV, which corresponds with this move back to normal volatility stats after a 2 sigma adverse move. It's now moved 3 sigma in our favor. So that's what quality looks like. The 10-day min pains are the ones that are relative strength winners. They have lost the least from their 10-day high, and then the 10-day max pain are the ones that are still the furthest percentage away from their 10-day high. We have a triple screen in the VIX, and then these in the auto framer all test out better than 2 to 1 just on the auto framer technique. No swing trade patterns to speak of, nothing firing on the auto framer. In the Dow, we still have a couple fraud quality numbers above 3. ExxonMobil could be of interest. It's number 2 on max pain range compression and fired an 8 on the RSI 2, so it's highlighted there. The top 6 here in the auto framer are all better than 2 to 1, so you're getting your VIX, oil, agriculture, gold, silver, and mixed commodities, so that's pretty clear. VIX on a triple screen. Coal fired at a 5 on RSI 2, and a ton of dojis to look at as well. The doji in XIV is of concern. So the swing trade that I've been talking about in XIV, that returned 14.3% over in the last 10 days and ends in a doji, so that's time to ensure that you've locked your profits in. Inside the auto framer, you have the stats on these that fired. And then among the regression line fractals, these top row symbols are the ones that have the highest number of ATRs below their own 270 regression line, which we take as the long-term fair value. So if they reverse and get back to the long-term trend, then McDonald's is 6.5 ATR, AXP at 6 ATR away from their 270 regression line. Home Depot, on the other, Intel, Procter & Gamble, and Microsoft, these are all the ones that are the greatest number of ATRs above the recent trend line. So Intel is 6.5 above, Home Depot almost 7 ATRs above, and that gives you just an idea on some targets for operations here. Nice rebound. This is an S&P. Nice rebound from that pullback, and now ending in a doji. Jaws are open to the upside. That's the polynomial regression. That's the straight line regression. That's hard to sustain that kind of gap. So some stability here would not be out of the ordinary. We have the slope of the 30-period regression line for the S&P. You can see it crossed its own 10-period outside in more than one SD away from the 6-month average, and that's a signal to create a potential shift in long-term trend, and that's what gets you this. That's what gets you this move right here. This was the key move right in here. That failure to fail leads to the grinding upward move from 194 to 199. So nice 3% move. You can see this is the 6-month time series of that. This is the last 30 days. You can see that just price relative to the 200-day moving average as a percentage has made a 2 sigma move back to just about the 6-month average. So the aging bull got his little shot of adrenaline or espresso and is back to normal is how we would interpret that. All right, so let's see if there's anything else you want to look at. Notice the strength in Microsoft. These are the swing Z trade scores based on how much it's gained or lost in the last 5, 10, 20, and 40 days. Microsoft and XLV, XLY all clearly have the relative strength, and those are good places to be. Looking for continuation patterns. Inside the Z scores of the regression line slopes, you can see that sharp move down in the S&P, and then the rebound, it went to 2 full SDs below. Then the slope of the 10 went 2 full SDs above and is starting to pull back a little bit. Still some room in here for the 30 to go. It's just back to the 6-month average, and so this would be a natural place for it to continue to grind north in much the same way we see this kind of move and then some gains. So here's a pullback and a gain. Here was a pullback and a gain. That gain continued. This one continued for a while. So I treat this as market has fought its way back up after what has become a significant pullback. This violation, this leaving, then rejoining the river, that's the Z pattern right there. Keep that one in your memory banks. You can see how the slope, the steepness of the slope in each case in the 10 period gets outside 2 sigma to the downside, followed by a nice sharp move. So you got to pay attention to those extreme conditions on the downside. After this excursion up here to +2, there was a sharp pullback, a minor pullback to the mean. I think the Bollinger Band mean is a reasonable stop level to protect you against the noise of another retracement here. So that's everything I want to talk about today. I'll get this uploaded to YouTube. Reminder of our live trading workshop in Kansas City in November. It's going to be excellent. Got some great traders coming in and already starting to work on their own research and trading practice. It's going to be some amazing crosstalk and peer-to-peer education. It's the best thing we got going. Take good care. We'll see you in the chat room. Keep your wrist measured and your powder dry.